Good day, my name is Nabila Binti Hamzah and welcome to my FinTech case review. Today I'll be talking about Chime, the neobank that broke American banking and how it has built $1.67 billion business without charging its customers a single fee. No branches, no minimums, just a slick app and a regulatory loophole the big banks never saw coming. To understand Chime's rise, we need to understand the structural failures it was responding to. Traditional American banking had three compounding problems for everyday consumers. First, overdraft fees. Banks were charging an average of $26.61 per transaction and were generating billions annually from this practice, punishing their most vulnerable consumers from lower income account holders. Second, the unbanked gap. 200 million Americans earning under $100,000 a year were not considered to be profitable to the big banks. And third, the net interest margin model itself. Traditional banks make money from lending, not from serving. So customers who don't borrow and don't maintain large balances are considered unprofitable to serve. Chime saw all three of those gaps and walked straight through with the proper solution. Chime's founding story didn't come from a whiteboard, it came from operational experience. Chris Braid, the co-founder and CEO, spent years as Chief Product Officer at Green Dot, a prepaid card company, where he noticed that lower-income Americans who linked their direct deposit were spending around $28,000 a year through their card. At 1.5% interchange, that's $420 in revenue per customer per year. No loans needed, no fees needed, just card swipes. So, in 2012, he co-founded Chime with Ryan King. The idea was simple. Get the direct deposit from customers, give them a designer card, charge them nothing, and make money every time they spend. By 2021, investors were so convinced that they valued Chime at $25 billion, the most valuable private neobank in the world. Now let's get into the mechanics because this is where it gets fascinating from a fintech perspective. Chime is not a bank, it is a technology company. Understanding that distinction is critical to understanding both its advantages and its risks. Structurally, Chime operates across three layers. At the top is the Chime app, the consumer-facing product that members interact with every day. Below it is Chime Core, their proprietary banking engine built fully in-house by 2025 and the system that runs underneath. At the base are the partner banks, the Bancorp Bank and Stride Bank, both FDIC-insured institutions that hold customer deposits and issue the physical cards. To put simply, Chime owns the user experience and the technology stack. The banks own the regulatory license, and Visa owns the payment rails. Now, here's where it gets interesting. The 2010 Dodd-Frank Act capped interchange fees for big banks at 0.21% per transaction, but Bancorp and Stride are small banks, which means they are exempt from that cap. So, Chime earns 1 to 2% interchange versus 0.21% for Chase Bank. That's up to 10 times more revenue per swipe. That one regulatory gap is the entire business model. How does Chime actually make $1.67 billion without charging customers a single cent? The answer is interchange. When customers swipe their Chime Visa debit card at a merchant, that merchant pays a small processing fee to the card network. Every time a Chime member swipes their card, the merchant pays a small processing fee. Chime gets about 50 cents of every $100 spent. Now, multiply that by 8.6 million active members, each making 54 transactions a month, mostly on groceries, petrol, utilities, and the number gets very large very fast. 76% of revenue is pure interchange, 12% is MyPay wage advances, the rest is ATM fees and platform revenue, and the margins, 88% gross margin in the first quarter of 2025. For context, that is exceptional for any financial business. The Chime's product strategy is basically make living impossible. Their first product, SpotMe, is their fee-free overdraft, up to $200, no charge, recovered from your next paycheck. Traditional banks charge $27 for the same thing. Members who use SpotMe churn at dramatically lower rates because there is no equivalent elsewhere. It's covered $30 billion in transactions since 2019. The second product, Credit Builder, is a secured credit card, no credit check, no interest, no annual fee. You fund your own spending limit. Chime reports on-time payments to all three bureaus, and you build credit with zero risk to either side. And lastly, MyPay lets you access wages you've already earned before payday, up to $500. $8.8 billion advanced so far at a 1% loss rate and 60% transaction margin. Payday lenders charge 400% APR for the same thing. Chime charges a small flat fee. Each product solves a real problem, locks the member in deeper, and generates interchange revenue while doing so. Now let's look at Chime's financial performance, where the numbers tell a pretty satisfying story. Revenue went from $900 million in 2022 to $1.28 billion in 2023 to $1.67 billion in 2024, consistent 30% growth year on year, and Q1 2025 implies a $2 billion run rate. But the real story is the losses. In 2022, Chime was burning $470 million a year, then $203 million, then $25 million. Then in Q1 2025, they achieved their first ever profitable quarter, $12.9 million in net income. That's nearly a $500 million improvement in 3 years without cutting the product. On a per member basis, Chime generates $251 per active member. Chase Bank earns $731, but Chase is serving a completely different, wealthier customer base. For the paycheck to paycheck segment, $251 at 88% gross margin represents genuinely strong unit economics and validates the core thesis that this customer segment can be profitably served at scale. In June 2025, after years of delays caused by market volatility and then uncertainty around US trade policy in early 2025, Chime finally went public on the Nasdaq under the ticker CHYM. It priced at $27 per share, top of its range, valuing the company at $11.6 billion. The IPO raised $864 million in proceeds from 32 million shares sold. On the first day of its running of trading, the stock closed at $37.11, up 37%, briefly implying a market cap of around $18 billion, one of the strongest fintech IPO debuts in recent years. At its 2021 Series G, Chime was valued at $25 billion, approximately 19 times revenue, reflecting the zero interest rate era's willingness to price on growth rather than earnings. The 2025 IPO at 7 times trailing revenue tells a different story. Post-pandemic public markets are requiring profitability, margin discipline, and credible unit economics. Chime delivered all three. Institutional ownership going into the IPO was led by DST Global at 17% and Crosslink Capital at 9.5%. Sequoia, SoftBank, and Tiger Global participated at the 2021 peak. The proceeds are positioned as growth capital, primarily to fund expansion into lending, rather than a rescue of a distressed balance sheet. Chime exited Q1 2025 with $1.1 billion in cash and minimal debt. Any rigorous analysis requires an honest assessment of the risks, and Chime has some significant structural vulnerabilities. The most critical risk is interchange dependency. Between 76 and 90% of Chime's revenue depends on interchange fees. The entire model is built on the Dodd-Frank small bank exemption remaining intact. If regulators ever extend the Durbin Amendment caps to smaller banks, the very regulatory loophole that Chime exploits, Chime's interchange rate drops from 1 to 2% down to 0.21% overnight. That is an existential threat to the current business model. This risk is rated high because it requires only a single regulatory decision to materialize. The second risk is the absence of a banking charter creates operational dependency on Bancorp and Stride. Any regulatory action or capital stress at those partner banks has direct downstream consequences for Chime's customers and operations. Third, lending margin compression. Expanding into MyPay and personal loans compressed Chime's transaction margins from 79% to 67% in Q1 2025 alone. Chime has no history of managing credit risk at scale, and losses could accelerate sharply in a recessionary environment. And fourth, the big bank catch-up. Chase, Wells Fargo, and Capital One are all making serious mobile banking investments. Wells Fargo launched early paycheck access in 2022. Chime's user experience advantage is real, but it's not permanent. So, did Chime really break American banking? The analytical answer is not structurally, but consequentially. What Chime demonstrated is that the mass market could be served profitably without fees, and that forced the entire industry to evolve with a model it had relied on for decades. What clearly worked? Chime found a legal gap in Dodd-Frank, built a product that genuinely served people that everyone else ignored, and made 88% gross margins doing so. The path from a $470 million net loss to first profitability in 3 years without sacrificing the product is a meaningful operational achievement. What's still unproven? Whether lending works at scale, whether the Durbin exemption survives, and whether Chase's digital push eventually catches up. The core academic takeaway from this case is the interplay between two mechanisms: regulatory arbitrage as the financial foundation and behavioral lock-in as the retention engine. Chime didn't disrupt banking through technology alone. It found a structural gap, built trust with customers everyone else had abandoned, and monetized that trust through every transaction. Whether that proves durable in the long run is the question that is open in the future. And these are the 15 sources I have drawn on throughout this presentation. Thank you for watching, and I hope this video gave a rigorous analytical view of how Chime built one of the most interesting business models in modern financial technology.